Welcome everyone to today's webinar. Thank you so much for taking time to join. We are going to be going over a topic that we get a lot of questions about. And so hopefully you find this helpful. Please ask questions in the chat. If you're watching this as a recording, you can ask questions in the comments or you can contact us. And as we get to the end of the presentation, I'm going to give you information about how you can ask specific questions about your situation and how to contact us to get more information. So let's get started. Today's topic is talking about how to contribute to more than one retirement plan. So like I said, it's a very common topic, and so hopefully this is helpful. We're going to be going over the rules that apply and how they apply differently to employee versus employer contributions, the 403B exception, the exception for voluntary after-tax contributions, and like I said, how to get more information about your situation. So the starting point for this type of discussion is talking about the difference between how the rules apply for employee versus employer contributions. And let's just set the stage with a simple example. So let's say that you have somebody that has a day job, and through that day job, they have a 401k plan, and then they're also separately self-employed. And they don't have any full-time employees. Let's say they've got, a day job working for a Fortune 500 company, and they're also an independent consultant, which allows them to have a solo 401k because they don't have any full-time employees working for them. And so when it comes to the solo 401k, as well as their day job plan, they can make contributions as an employee, what's also called elective salary deferrals. So that employee contribution limit, that applies at the employee level. So for example, for 2020, the limit is $19,500 or an additional $6,500 if they're 50 or older. So here on the screen here, we've got a simple example. Consider Joe, age 46. So he can't do the catch-up contribution because he's not 50 or older. He has a day job with an employer with a 401k plan. He also has a separate unrelated business with no full-time employees that sponsors a solo 401k. If he contributes the maximum employee contribution, which is $19,500 for 2020, to his day job 401k plan, he cannot make any more employee contributions to the solo 401k, because it goes back to what I was saying, that the limit applies at the employee level. So he's already filled up that bucket essentially. Now, one exception here is voluntary after-tax contributions, which we're going to discuss more in detail on a later slide. The other type of contribution that can be made to the solo 401k is an employer contribution, and that's also called a profit-sharing contribution. So the employer contribution limit applies at the employer level. So here, even though Joe can't make any more employee contributions to his solo 401k, he can still make employer contributions based on his self-employment income and subject to the solo 401k contribution limits. So for example, let's say that his self-employed business is taxed as an S corporation, and he receives W-2 wages from his own S corporation. Let's say he receives $50,000 in W-2 wages. So even though he can't make any more employee contributions because he's already maximized to his day job plan, he could still make a pre-tax employer contribution equal to 25% of his W-2 wages, which would be $12,500 to the solo 401k. Now, what gets interesting here is that if you have significant self-employment income, let's say that justified at a maximum $57,000 contribution as a pre-tax employer contribution, then on top of that, you're making contributions to your day job, you can see that you're actually able to make contributions that in total exceed the overall limit. So you can even get above 57. You could be potentially maybe in the 70s or the 80s in terms of how much you're contributing across all the different plans that you participate in. And I see that we've got some questions here, which is great. I really appreciate you actively participating. Please don't hesitate to ask those questions. And I'm going to touch on that in a second. Just to finish the slide, the exception though here would be number one, employers under common ownership, what's often referred to as a controlled group or an affiliated service group. So if the two employers are under common ownership, so they're a control group or they're an affiliated service group, then you do have to aggregate for purposes of the determining whether the limit has been met. So if Joe has a job where he owns the company that has a 401k plan, and then he has a separate solo 401k for his independent consulting, he's going to have to aggregate for purposes of determining whether that employer contribution limit has been met. And then the second exception here is the 403B exception, which we're going to talk about on a later slide. So let's look at this good comment though. So thank you. It says, what if my day job, or what if at my day job I have a 401A maxing out 19.5 and also have a 403B, employer contributing 20,000? Can I still have my solo 401k employer contribute to the solo 401k? So I think the question there is going to be addressed on our 403B exception slide. So let's move on and talk about that exception. So that's a great segue. Thanks for asking that question. So 403B plans are an exception to that general multiple employer rule that we just talked about, how you don't aggregate as long as they're not under common ownership. So taking the example from the prior slide, let's assume that Joe worked for a school full-time and participated in their 403B plan. For purposes of the plan contribution limits, he would be treated as if he was participating in one employer retirement plan. So the total contributions to both plans couldn't exceed the overall limit. For 2019, it's 56,000 or 62 if he's 50 or older. For 2020, it's 57 or 63.5 if he's 50 or older. So back to the comment in the chat here. So you would need to add in that $20,000 403B and treat it as if it's being made to the solo 401k for purposes of determining whether or what the limit is. So you would need to reduce, in other words, your overall limit by that 20. And then you could then make the employer contribution disregarding the 19.5 that you made to your day job plan for purposes of the overall limit. Hopefully that makes sense. Thank you for asking that question. So again, yeah, please don't hesitate to ask questions. And if you're watching this on the recording, you can ask questions in the comments or contact us. We're going to talk about how to contact us at the end here. So let's go on to another one of the exceptions that I mentioned on the first substantive slide that we went over. So voluntary after-tax contributions. So the general rule is that employee contributions and the employee contribution limit applies at the employee level. One type of employee contribution is the voluntary after-tax contributions. So what's interesting is that even though that's an employee contribution, the limit is actually applied at the employer level for unrelated employers. So let's tweak our example again to illustrate the point. So Joe could make voluntary after-tax contributions up to the applicable limit, notwithstanding that he maximized his elective deferrals to his day job plan. And I see some more comments coming in, so we'll talk about that in a second. Thank you for making those comments. So remember, in Joe's example, he has a day job plan where he's maximizing the contribution, $19,500 for 2020 because he's under 50. So that's the maximum employee contribution limit. So if he wanted to make a voluntary after-tax contribution to his solo 401k, again, let's assume that he's an S Corp and he gets $50,000 in W-2 wages from his business, which is taxed as an S corp. So he could make a voluntary after-tax contribution equal to 100% of his self-employment compensation, which in his case is his W-2 wages, which we're assuming is $50,000. So notwithstanding that he made a $19,500 contribution to his day job plan. So, and that's assuming he doesn't make any more employer contributions to his solo 401k, because the voluntary after-tax limit is 100% of the self-employment compensation, not to exceed the overall limit, which in his case would be 57,000 since it's 2020 and he's under 50, reduced by any employer or employee contributions made to the solo 401k. So if he doesn't make any employee contributions, which he can't because he already maxed out to his day job, and let's assume he doesn't make any pre-tax employer contributions, he could put 100% of his wages, 50,000, in as a voluntary after-tax contribution. So the point here is, even though that's considered an employee contribution, you apply the limit at the employer level, like we just went through. And he might want to do that if he was trying to make a Mega Backdoor Roth contribution, for example. Now, the note here at the bottom is that 403B exception still applies. So if, like in the comments, let's say that he had a 403B, then he would need to aggregate those 403B contributions along with his solo 401k contributions to figure out if he's meeting or exceeding the limit. So hopefully this sheds some good light on some of these topics where it can get a little complicated, where you're participating in different plans. And again, happy to address more comments or questions in the comments, or if you want to contact us, you can contact us to learn more about your situation at business@mysolo401k.net, or you can call us at 1-800-489-7571. So, and please keep the questions and comments coming. I see here we've got a follow-up question. So let me take a look at this. So we've got 20,000 plus 19.5. It's more on our previous conversation, 39.5 already. So whatever is left can be contributed to the solo 401k as a profit sharing and or Roth. Does Roth 401k participant also fall under the limit? So let's unpack that good comment a little bit. So when you're talking about making a Roth contribution, that's always going to be made, and I'm talking about a true Roth contribution, not a voluntary after tax that you then transfer to the Roth. So a Roth contribution is always going to be an employee contribution. So that's the $19,500 limit. So in this situation, we're saying that you already made $19,500 in contributions to your day job plan. So you can't make any more employee contributions. So you can't make any more, you can't make a Roth contribution to the solo. So no, you cannot do that. Then let's assume that you have a $20,000 contribution made to a 403B. So that means that if you wanted to make, it looks like what your objective here is to make a profit sharing contribution. So, and I'm pulling back up the slide that talks about employer contributions, which are profit sharing contributions. So in your case, I'm not sure how your business is taxed, but let's assume that you were, your business is taxed as an S corporation. So your ability to make a profit sharing contribution is going to be based off of your W-2 wages that you get from your S corporation. So let's assume that you have $100,000 of W-2 wages from your S corporation. So, or let's assume you have $200,000, just to make it a little bit more interesting. So in that situation, you could make all, before we get into the 403B exception, you could make a $50,000 profit sharing contribution, because that's 25% of your W-2 wages. However, you are now adding on the fact that you had a $20,000 403B contribution. So you would have to reduce the overall limit for 2020, which is 57, by 20,000. So now the most that you can make would be 37. So even though you have $200,000 of self-employment compensation, W-2 wages from your S corp, which could justify a $50,000 profit sharing contribution, you can't make it because the most that you can make would be a 37,000 contribution in that case. So the key takeaway here is you do have to consider the $20,000 403B contribution, like you're mentioning in your comment, but you don't consider the $19,500 contribution for purposes of determining how much you can contribute as an employer. But you do consider it for purposes of how much you can contribute as an employee, like a Roth contribution. So hopefully that helped. Thank you again for that comment. Please ask any more comments. We do have more time here. I'll remind people to please like this video and subscribe for more videos like this. We do weekly webinars here, so you'll get notifications of the webinars, notifications of when the recording is posted. So it's a great way to connect. So let's do that. Let's connect. And if you're watching this video on a recording, please feel free to ask comments or ask questions in the comments, and we will address those that way. Contact us at business@mysolo401k.net or call us at 1-800-489-7571. Thanks again, everyone, for participating and watching, and have a great day.